Hello, everyone, and welcome to the Advisor Upside podcast from ETF.com. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com, and this episode features Nate Geraci of the ETF Store. Hey, Nate, thanks for being here.
It's my pleasure. Thank you for having me on.
Yeah, well, we want to get right into this with a little bit of your background so our audience knows who you are if they don't already. Tell us a little bit about yourself and the ETF Store, which I got to tell you, I've interviewed you multiple times, and I still think that's a rather unique name for a financial advisory firm.
So I'm president of the ETF Store. We are an independent registered investment advisory firm based in Kansas City. We have no broker-dealer affiliation, and we primarily work with retail clients of all stripes. So everyone from a new couple just starting out with their careers to retirees. We have high net worth individuals. It really runs the full spectrum. And we're a full service wealth management firm. So we obviously handle the investment side of the equation, but we do everything else from financial planning to
Mm-hmm.
retirement forecasting, insurance. We really take a full 360-degree view of our clients' financial future. I'll also note I host the weekly podcast ETF Prime.
Yep.
I blog at the etfeducator.com. And I co-founded the ETF Institute, which is professional education and certification around ETF. So I always say I eat, sleep, and breathe
Mm-hmm.
ETFs.
Yeah. Okay. Thanks for that. A lot of great places where people can go to find you. And I'm assuming, based on the company name, that you rely pretty heavily on ETFs for your portfolio management, right?
We do. So we build our own model portfolios in-house. Those are 100% all ETF asset allocation models that span from very aggressive to very conservative. We have income-oriented models, but yes, we consider ourselves ETF experts, and that is certainly a key part of everything that we do.
Okay. Now you say you build models. How tailored or customized can those be for clients?
Yeah, so it's interesting. Our models are strategic asset allocation models. They typically hold, say, between 10 and 12, 13 ETFs. We obviously have an equity sleeve and a fixed income sleeve, and then we do hold a small allocation to gold. But our process, I think it's important just to offer a high-level overview here.
Hmm.
We have an investment committee that meets every month to discuss the global markets and the economy, what's going on with the Fed, valuations, everything that you might expect. But even though we meet monthly, we're not necessarily making changes monthly. We're very methodical in how we go about tailoring investment portfolios. And so we may make, say, two or three changes a year. And that's really because, again, we're focusing on the longer term. That said, while we have these models, our individual advisors always have the ability to tailor them as they see fit. And it gets really interesting because our core models are pretty straightforward, but
Hmm.
we may have clients that come to us and they have a passion or an interest around, say, a thematic segment of the market. And so we may have an advisor who allocates a small percentage of the portfolio to a thematic ETF. So
Uh-huh.
we have the ability to tailor the portfolios as needed. But in general, we're strategic asset allocators.
Okay. Now, it sounds like you don't do this, but I want to know what you think about outsourcing asset management, investment management. A lot of it's increasingly popular across the financial advisory space. There's obviously all kinds of ways to do it. Turnkey asset management platforms. There's advisory firms that will, let you kind of jump on their models. What are your thoughts on that outsourcing investment management? And I ask you that primarily because that the assets is primarily the way most financial advisory firms charge fees to clients.
I think there are some real pros, but also cons to outsourcing investment management. For advisors who perhaps don't have the investment expertise or investment acumen, and they want to focus solely on their client relationships, model portfolios are clearly an excellent option. It's like
Hmm.
an easy button approach to an important aspect of running an investment advisory firm. From my standpoint and for our firm, We believe that we have those in-house capabilities to manage models. So we have two CFAs on staff. We've been doing this for a long time, and so we're very comfortable with managing our models in-house. And the way that we have always viewed this is that at the end of the day, clients hold us responsible for their investments. And we feel like if we outsource that piece, we're outsourcing that responsibility.
Uh-huh.
And that's just not something that we feel comfortable doing. Now, some advisors may look at that as a good thing because if they outsource that responsibility and say the model portfolios underperform, then they can go to their client and say, see, it was somebody else who underperformed, and we're going
Right.
to fire them. We're going to use another model portfolio provider now. And maybe that's viewed as a benefit. That's just not who we are and how we wanted to approach this piece. But to be clear, I certainly see the value depending upon the type of advisory firm to outsourcing models, because there are some very smart investment shops out there, some of the largest investment shops in the world that offer
Hmm.
very robust models, and that can be a value add. I think it's really just a matter of how you view that piece and how important it is. And I'll just add to that, while we focus on all aspects of an individual's financial life, and the investment component is just a piece of that, clients view that piece as being a very important component.
Hmm.
And so, what I hear on this topic quite a bit is the investment piece is just a small sliver. We focus on all these other aspects of a client's financial life. And so it's fine. Let's just outsource that investment management piece and focus on the other areas. I get that. I'm just telling you from a client perspective, they put a lot more emphasis on that investment piece.
I'd like to hear a little bit about your communication with clients when it comes to portfolio construction. I'm not just talking about your, maybe your annual or quarterly meetings with clients, but how do you articulate this to clients that you are doing all of this in-house? And to me, that seems like a value add to be able to explain that, because I'm assuming a lot of clients at maybe some advisory firms just take their money there, they have their meetings, they talk about their risk profiles and stuff like that and their goals, and then they see their portfolios. But to me, it seems like if you're doing it in-house, you should be selling that point.
The benefit of doing it in-house is that all of our advisors know exactly the rationale for why we own what we do in a portfolio. They know about the ETF. They know,
Hmm.
how we're tying that into the markets. And so if you think about that, if your advisors know the rationale for every holding that you have, it makes it very easy for them to then convey that to the end client.
Hmm.
And for our firm, client communication is absolutely critical. I think that's one of the most important things that any advisory firm can do. And so for us, that's ongoing. And we do all the things that you might expect. We have a quarterly newsletter. We're in constant communication with clients, but our advisors, it's not just an annual meeting or a
Hmm.
quarterly meeting. They're prepared to speak to everything that we own at any point in time. And if we make changes, they're proactively communicating with clients as to why we did that. And it's so to me, it's table stakes. Communication is table stakes. If you're not doing that on an ongoing basis and being proactive about it, I think that you're missing the boat on one of the most important things of being a financial advisor.
I'm going to ask you now for some kind of a horror story or a wild success story that you can share since you've been doing this. Something that maybe advisors listening could learn from.
Yeah, I guess I'll go positive and share a success story. And going back to portfolio management, we're not market timers by any stretch of the imagination, but
Hmm.
I'll tell you that we call the Fed's moves over the past several years darn near perfect. And so if you go back to say late 2020, early 2021, it was highly apparent to us that inflation was accelerating and the Fed was not going to react quickly enough. And so within our
Hmm.
portfolios, we got very short duration on our fixed income holdings. And we held things like target duration TIPS ETFs and investment grade floating rate note ETFs. And so we were extremely well positioned for what happened in 2022 when the Fed aggressively started hiking rates. And
Hmm.
that's important because again, while we're not market timers, it showed the diligence that we were putting into to managing our models. And of course, we can, as we talked about previously, we were communicating with clients about this all along the way. And I just think that again, I'm gonna be a broken record here. This all gets back into client communication at the end of
Hmm.
the day. So we got the portfolio component piece right, but then we communicated properly with clients the entire way through.
All right. Well, since you're talking about getting the Fed right, the Fed is now on the cusp of, I guess, cutting rates. How are you preparing client portfolios for that?
Yeah, we still believe the Fed is going to stay higher for longer.
Hmm.
And if you look at the risk return dynamics within fixed
Hmm.
income right now, we still think going too far out on the curve doesn't make a ton of sense. We still think there's risk there to be an extremely long duration. So we're still shorter duration overall, though we have started moving more towards the intermediate part of the curve. But I think we're taking a cautious approach, and here's why. The Fed clearly did not get this right in handling inflation when it first started taking off. So we're not going to bet that they're going to get it perfectly
Uh-huh.
on the way down. So they've navigated everything from an economic standpoint. Things look okay. They seem to be a little bit behind the curve in no pun intended in managing this entire process. So we're gonna use the lessons that we've seen over the past couple of years and assume we're gonna see that going forward.
Okay. All right. We can't ignore cryptocurrencies and spot Bitcoin ETFs launched in January. Where are you when it comes to crypto investing? Do you subscribe? Do your clients long for it? Are you jumping all over these spot Bitcoin ETFs? What?
You know, it's funny because people see me constantly talking about this topic and tweeting about this topic, and the assumption is that I'm some sort of Bitcoin maxi. The truth of the matter is, and I've said this multiple times in the past, look, it is still so early in Bitcoin in crypto. And I don't think anybody knows for sure where this is all heading. And
Uh-huh.
so I've been very consistent in saying that Bitcoin could be an absolute home run, or it could go to zero. And maybe, some people may view that as extreme and that's not really helpful. But I think in the context of incorporating it into an investment portfolio, that's how investors should think about it. Now, that said, I will say if you look at the data that we have thus far, which admittedly is a small sample size, but go back to 2009, 2010 and play this forward. If you had had a small allocation to Bitcoin, say 1 to 5%,
Hmm.
in a globally diversified portfolio, that would have improved the overall risk return characteristics of that portfolio. And I don't think that investors and advisors can just ignore that. And so currently at our firm, our advisors do have the ability to invest clients in spot Bitcoin ETFs if they so choose, but we have not yet made an allocation within our models. But again, as we talked about earlier, advisors can always tailor those models, and certainly Bitcoin can be a part of that. I just think that the communication piece is so important here because look, we've received a lot of questions from
Hmm.
clients on Bitcoin and crypto. I would say more questions than necessarily clients explicitly wanting an allocation to it in a portfolio. But this gets back into, again, this is a common thread with everything we've talked about so far. I know Bitcoin and crypto are controversial topics among the advisory community. Some people love it, some people think it's complete vaporware. But regardless of where you stand, you have to be conversant in this area. You
Right.
owe that to your clients. And I would say it's not any different than any other asset class.
Hmm.
You may not want to allocate to junk bonds, but you have to be able to speak about them intelligently with clients. I would say it's no different with crypto.
Have you ever seen anything in your experience in wealth management that is comparable to what you just described as a potential home run or potential going to zero?
I mean, the easiest corollary there would be private equity. Um, But, private equity is something I don't think a lot of advisors necessarily allocate to, or the average advisor, but some do. So I think that's a space where you think private company could be a home run or it could go to zero.
Hmm.
Um, I think that's the first one that comes to mind for me.
Okay. What are some of the biggest challenges you face and you think the industry faces right now in wealth management?
For us, look, we're what I would consider to be a boutique investment advisory firm. So we manage just over $250 million in assets.
Hmm.
And I think the biggest challenge that a lot of advisors face, and I'll tie this into the industry as well, is just getting your message out to new prospective clients. And the reason for that is there's been a lot of consolidation in our industry over the years. And so there are now some enormous players in the RIA space that can suck the oxygen out of the room.
Hmm.
And so a prospective client may go, do I want to invest my life savings with a firm that has 250 million or 250 billion
Hmm.
in assets? Now, obviously, I believe there are significant advantages to going with a boutique firm. I would say, potentially better service. You're not getting a cookie cutter approach, those sorts of things. But
Hmm.
getting that message out into the marketplace is much easier said than done. And obviously, there are plenty of other boutique firms out there. But if you just think about the landscape now, because there's been so much consolidation, there are these really big players at the top. And so I think that can make it more difficult for smaller firms to convey their value proposition and not get lost in the noise. And I would say, tying this into the industry overall, because of that consolidation that we've seen, that's obviously been good for the largest players. But I don't think we want to lose what boutique firms bring to the table in terms of
Yeah.
solving problems and that entrepreneurial spirit and all those sorts of things, because I think that plays into the success of the end clients.
Hmm.
I think you have to have different solutions, customized solutions in the marketplace to solve the types of complex problems that clients face on the financial side.
Yeah, saying consolidation, it's almost an understatement at this point. I think record-setting merger and acquisition activity for more than a decade now. Has that resonated with you at all as far as maybe making an acquisition, and maybe you have, or maybe joining a larger firm, larger organization?
I mean, I think it's something that every advisory firm, once you get to a certain size, that's
Hmm.
something that you're going to have to consider and roadmap. We haven't certainly looked at, being acquired by a larger firm. We have evaluated acquiring smaller RIAs, but we have yet to do so. I think it's something that's always on the table. Um, I think again, as you gain scale and get bigger, it's I guess we become what I just said is potentially part of the problem with a
Hmm.
consolidation at the top. I don't have the solution there, but yes, I think it's something that we would consider.
In the time you've been in the business, how have you seen the financial advice industry evolve?
I think that there are just so many different ways you can go about building a financial advisory firm. And
Hmm.
some of the decision points around them we've talked about here today. Do you outsource investment management or do you keep it in-house? And you can apply that to nearly every aspect of an advisory firm. You can outsource compliance. You can outsource marketing. You can outsource your back office operations. There's so many different tools and pieces of software out there. And many of these solutions have come to the market over the past, say, 5 to 10 years. And so there is a lot to wade through for the average advisor. And I think the takeaway here is that a lot of these tools and solutions can obviously be helpful, but they're all not for every firm. And I think advisors have to think very strategically about how they want to incorporate these tools and services. And really, more importantly, how do they want to position themselves within the marketplace?
Hmm.
Because depending upon what you outsource, that's a message that you're sending to clients.
Hmm.
It's a message that you're sending to any employees you have or other advisors you have as part of the firm. And so there's just a lot of decisions to make around that. And I think that that's something that has changed quite a bit from when we first got involved here.
Speaking of outsourcing or going elsewhere for resources and I guess tools and services. How much thought have you given to the impact of AI on the advice industry?
We've thought a lot about it because there's no question AI will significantly impact the advice industry moving forward. I mean, you can already ask Chat GBT just about anything advice related,
Mm-hmm.
and it will serve up a pretty good answer. I mean, Chat GBT can already handle portfolio construction.
Mm-hmm.
We've used those tools. It can answer, again, retirement planning questions. So I think what that means is financial advisors have to have a value proposition outside of just offering basic investment portfolios or basic investment advice because AI can already do that.
Right.
And so I think from my standpoint, a big part of the value proposition that advisors need to focus on is the actual client relationship
Yeah.
because money is extremely important. It's extremely personal to most people. And I don't think that that's something that personal nature of money and financial planning is something that AI can replicate. And so that gets back into making sure you're fostering good relationships with your clients and surprise, surprise, communicating effectively and on an ongoing basis with clients. That's something that, again, AI can't replicate. But I think AI is going to have an enormous impact on our industry, especially for advisors who are just checking the box and don't have any sort of real value proposition.
Yeah. That's a whole different podcast. Stay tuned for that one. Nate, I want to kind of wrap up here with a little bit of a free gift for our audience. You've been in the industry for a while. You're a smart guy. What piece of advice would you give to someone just starting out in the financial planning industry, and or what advice would you give to someone just starting out with investing?
To somebody starting out in the industry, I would say without question, they should focus on polishing their communication and relationship building skills for all of the reasons we've already discussed. I mean, we were just
Hmm.
talking about the emergence of AI, and we've talked about the ability for advisors to outsource nearly every aspect of their business. But the one thing you can't outsource or AI can't replicate is the client relationship and how important that is. And again, communication is such a critical part of that. And so I think that, no matter your background, whether you're more investment focused or more advisor or advisory relationship focused, you have to have that polish on communication and relationship building skills. So I think without question, that would be my advice
Hmm.
to somebody in the financial planning industry. For someone just getting started with investing, um, look, I'm just really big on education and financial literacy, and I think sometimes there's so much information out there, and our field can be scary to wade into because of that. And I would just say embrace the educational process, embrace learning about things. Don't be scared. I talk to a lot of especially new investors who
Hmm.
they don't even know the basics around stocks and bonds. And the reason for that is we don't teach that in our schools. So
Yep.
we teach all these other things. We don't teach the basics of personal finance. And so there's a fear factor there. And I think anything that can be done to remove that fear factor and not be afraid to dive in and learn and even potentially make some mistakes is really important. So some of the best learning experiences for somebody just getting started with investing is actually making a couple of mistakes. Nothing catastrophic, but maybe they invest in a meme stock and get burned on it, and they go, you know what? Maybe that's not the best way to build a portfolio. Maybe I should look at low cost Vanguard index funds. The point being, I would just embrace it, try to remove that fear factor, and just focus on learning.
All right. That's a good point to leave us on. I want to thank Nate Geraci of the ETF Store. Nate, where can people find you on social media?
Probably the easiest place is on X, so at Nate Geraci.
Okay, great. Thank you. Thank you, Nate. Thanks for listening. You can find us at ETF.com or wherever you find your podcast. This is Jeff Benjamin with Advisor Upside.